Hey everybody, welcome back to the channel. Today we're going to be reacting to a clip from SOFI CEO Anthony Noto talking about product differentiation and diversification leading to their success. Now, this was a clip from about May 2022. Obviously, I'm a new SOFI, got to SOFI the world what they can do. SOFI shareholder, so I'm going back in time and sort of watching these old clips and trying to understand how the CEO was thinking and sort of where they are in the world. And this was when their share price was actually $5.37. So we are trading a little bit higher than where we were back on May 11, 2022. Could it fall lower? Yes, it absolutely could fall lower. But I want to take a look and understand basically why Anthony Noto believes the diversification of SOFI is good enough to keep them going. So let's take a look at this clip and I'll analyze as it plays.
First, what's the state of the consumer from your perspective and your ability to sort of predict who's worth issuing credit to?
Yeah, the best way to think about our business is that we're in a diverse set of businesses because we have a unique strategy. We've developed a one-stop shop on digital for all your financial needs. So we have 4 different loan types. We also have a new checking account with 1.25% interest when you do direct deposit. We're also in the invest business, so single stocks, robo, crypto, as well as ETFs. And then we have a technology platform that may not be that well understood. We power a number of the key neobanks as well as B2B enterprises through our Galileo technology, as well as Technisys, which is a core banking technology. So 3 different businesses that all have different growth characteristics. I'd say our members.
So already, right, he's describing some of the diversification. Number 1, they offer a bunch of different types of loans, which is typical for a financial institution. Number 2, they're a one-stop shop. They're a one-stop shop for financial services, crypto, ETF, stocks, trading, right? You get that all in one place when you sign up with a SOFI account and you're kind of in their ecosystem. And then number 3, the part of the business that is fundamentally misunderstood that I've been trying to understand a lot more, which is that they power the banking infrastructure and the payment processing infrastructure for other fintech companies that exist, like Robinhood, Chime, Moneyline, through their Galileo and Technisys technologies. So 3 different ways they diversify with their technology.
Is doing quite well. It's a high mass affluent member. Average income for our loans right now is over $160,000 and really strong credit at 740 plus FICO score. So that diversification is allowing us to gain market share. That's driving the record results. The $322 million of revenue you mentioned was up 49% year over year. And we had our 7th consecutive quarter of positive EBITDA, which is what we think is the best measure of profitability for our business. And
so 7 quarters of profitable of EBITDA increasing, 49% year over year growth, and their ability to have all these different diverse streams that actually leads to them sort of being what they think they can become, which is a market leader in the financial services space.
And we have a great balance sheet. So the diversification of our businesses allow us to overcome a lot of the volatility in the marketplace and drive such consistent results, which is why we also raised our outlook for the year to 1.5 billion plus, and 100, that's in revenue, and 100 million in EBITDA.
Okay, but so as interest rates rise, how does your pitch to your customer and your potential customer change then? Are you planning on offering higher yield savings and that sort of underpins your business? What's the sort of unfair advantage that you plan to exploit during this difficult period?
John, great question. We're very fortunate to get a national banking license in January. We opened the bank in February. We launched a brand new checking and savings account that's really unmatched in its value proposition. We give you 1.25% interest on your checking account. In addition to that,
and by the way, that is really amazing. So first of all, on the loans point, one point I forgot to mention is that they're only giving loans to people that are an income of $160,000 and a FICO credit score of 740. So that also qualifies that the money they're giving out, they're more likely than not going to be able to get it back because they're giving it to people that can afford it. And then on the banking side, I mean, they got the banking charter in January, opened it up by February, and now 1.25% yield on your check. I mean, you don't get that in most places. So this is also, I do think it is a key competitive difference because Bank of America is not giving you 1.25%.
We charge no account fees, no minimums, and we have the ability to give you many other services such as free certified financial planner when you use that account, in addition to free roundups and 2-day early paycheck. If you do direct deposit with us, that's a great account and a huge differentiator. it's a differentiator not just to the consumer, but it also lowers our cost of funding our loans. We have a funding cost that was about 2x that before becoming a bank. We can now use our members' deposits that are up to $1.5 billion and growing about $100 million a week. And so now we have a lower cost of funding loans, which means we can get attractive prices.
Which is really important because before they were a bank, they had to fund them. They had to fund the loans internally themselves, right, to backstop it. But now, because you're a bank, what do banks do? They're in the business of, hey, you give me your money. I basically have an IOU on your money, and then I can take your money, put it somewhere else, make more money off of it, and right, that's how I make money. But your money's secure with me. Now SoFi can do that. They're growing at $100 million more a week, and like that's a really, really unique value proposition that is not only good for the consumer, but also good for the business. Not like they're just giving out 1.25% to give it. The more money they get, the more people they get. I actually made my SoFi account a couple of days ago. I'm going to start doing money in direct deposit because it's a no-brainer for me to get 1.25% off that. That's going to be good for the company itself because now it's going to be cheaper to actually be able to fund their operations.
Right. Right, and I know you've talked about the differences in your customer base. Anthony, you're still talking in terms of profitability in adjusted EBITDA, but the market and other CEOs have acknowledged that investors don't really want to hear that anymore. They want to look to positive free cash flow and net income profitability. Can you guys get there, especially if we're facing an economic slowdown? Should you be changing the way that you talk to investors?
We actually think the best value driver is free cash flow. And if you take our EBITDA and subtract our CapEx, that's the best measure of free cash flow. GAAP net income is not a full cash measurement, and that's why people are talking about free cash flow. And that's
GAAP is generally accepted accounting principles. It generally tells how much money a company's made profit-wise, net income, but free cash flow is also a better way of thinking about it.
Typically defined as operating cash flow less CapEx, but for a financial services company, because you're using your cash to fund your loans, we believe EBITDA less CapEx is a better measurement of cash flow because that drives increasing book value.
So, and that increase in book value makes a lot of sense because if you're using your funds to be able to do things with it to drive your revenue, then you can't just use like generally accepted accounting principles for a financial services company, or at least it's not one of the better ways to do it. So it makes sense the different way he's sort of explaining for it to operate in.
Our book value today is $5.5 billion. And we'll continue to grow that because of that measurement.
I think that makes a lot of sense. Anthony NOTO seems like he knows what he's talking about here. And the point I wanted to get across in that clip when the stock price... Come on, Jim Cramer. I didn't want to hear you write that. The point I was trying to get across there is that, like, well, it's a diversified business, and it's an incredibly interesting diversified business because one of the parts of the business that is not hitting its mainstream potential yet at all, Galileo, has a lot of more room to grow. A lot of more members have a reason to come to SoFi if you're getting 1.25%. The loans business is seemingly more transparent and unique, and you know you're going to give your loans to people that are actually going to be able to pay your money back. This is an interesting company. It's starting to grow at a rapid pace. And, you know, with the macroeconomic headwinds coming, they seem well positioned to be able to get through that because of the unique benefits they're offering the end consumer, full financial suite of products, being able to give you 1.25% yield. And it ultimately helps them as a company. The question is going to be how the market and interest rates react over the next 4 or 5 months to determine the price of the stock. It was trading at $537 in May. Now it's at like $610. I mean, really, there's no difference. It could get as low as $482, which I think was its 52-week low. We don't know what's going to happen to the stock, but looking at the company and looking at their potential and looking at what they're actually doing, one could argue that this has an asymmetrical risk reward associated with it. And I did a couple of other SoFi interviews that you can look at. I'll link them below. That actually explains why that's necessarily the case. But a diversified business, that's what I wanted to get across in this clip. That's what Anthony NOTO is promoting. And that's essentially what you're betting on if you are betting on SoFi. So thank you all for listening and watching. Let me know your thoughts on SoFi. I'll see you in the next one.